Every single trader's number one struggle, no matter who you are, is getting the trade's direction right. Every trader hits the same wall. No matter how hard they try, they can't get the trade's direction right consistently. Their win rate is low. And that's a critical problem because you can have the cleanest entry and the best risk reward, but no matter how you structure it, if you get the direction wrong, your trade will lose. I would try to force my way through it by trying to change my risk reward or entering earlier, but none of it actually moved the needle. Because I wasn't fixing the actual problem. The problem was that I had no repeatable and objective way of determining the direction. Every trade felt different, so I'd evaluate it differently. And you can't build a consistently high win rate on something inconsistent. I needed a process that gave me the same answer every time I looked at the chart. That's where the EMA cloud came in. Just by using this indicator, I was able to dramatically increase my win rate, basically overnight. So in this video, I'm going to show you exactly how to use it to get direction right with haunting accuracy. The 2050 EMA is one of the most common indicators, but no one uses it correctly. Because the thing is, there are two ways to increase your win rate. One is to take more winning trades, and the other is to win more of the trades that you take. Everyone tries to take more winning trades, but those trades also invite more losers. So you win more and then lose more, and now you're back where you started. And the market doesn't just offer hundreds of easy wins. It's not that easy. So if you go down the route of finding more winning trades, you're going to need to put in a lot of effort for a very small return, if any. So the key is to just nail a few high-quality trades, and more importantly, avoid the wrong ones that drag down your win rate. That's how you actually scale and grow quickly. Not through brute force or hard work, but through filtering and working smarter. So let's look at exactly how we do that with the EMA cloud. Now the EMA cloud is just two exponential moving averages. And the purpose of moving averages is to smooth out price action so you can identify the trend and momentum in just a few seconds. This already gives you a huge advantage over just looking at price action alone, since price action is incredibly messy and hard to read. The best way to actually get a high win rate is to know where the market is more likely to move. And that's where trend and momentum using the cloud come in. We can tell how strong a trend is just by looking at the slope and thickness of the cloud, and it ranges all the way from weak trend to healthy trend to parabolic. Weak trends and parabolic trends are unstable, while a healthy trend is the one you want to look for. Now, the key to getting a high win rate is multi-time frame alignment, because if you look at one time frame and the cloud is bullish, but we're right at a strong resistance level on a higher time frame, that trade might not pan out the way you want it to. It's not that it's guaranteed to go one way or the other, it's just that it doesn't have a strong probability toward either side. Trying to trade these probably won't get you a high win rate. And this is how the market looks most of the time, which is why it's difficult to get a high win rate from trading more. We only want to trade when there's multi-time frame alignment because that gives us the highest probability. And we can do that with just the cloud on just one chart. Let me show you how. We're going to be on the 5-minute, and this will be our lowest time frame. We already have the 5-minute cloud. Now we'll add this indicator 3 more times. For the next one, you're going to go into settings and change it to 60 and 150. And it should look something like this on your chart. This is going to be our 15-minute cloud. Since the 15-minute is 3 times the size of the 5-minute, the cloud settings will also be 3 times the size of the 20 and 50 cloud. And for the next one, you're going to go into settings and change it to 120 and 300. This is for the 30-minute, which is twice the size of the 15-minute, or 6 times the size of the 5-minute. And the last one is going to be the 1 hour, and settings for that will be 240 and 600. And once you've added all of those on your chart, it should look something like this. A few EMA clouds together, or an EMA ribbon. So what you have here is a multi-time frame view of the trend on a single chart. The innermost cloud is going to be the most sensitive to change, so this is where you'll get an early heads up on potential price changes and movement. The outermost cloud is the least sensitive to change and the slowest. So this will give you the clearest read of direction. Because the thing is, there are long-term buyers and sellers, there are medium-term buyers and sellers, and there are short-term buyers and sellers. If we rely on just one of these, we don't get the full picture. So, like I said before, one time frame might be bullish while the other might be bearish, or vice versa. Short-term buyers might boost the price up on a smaller time frame, only to be shot down by long-term sellers who are in control on a higher time frame. You can't know any of this if you're just on one time frame, and especially not if you're only trading price action. It's impossible to know who's in control on which time frame and where they're taking the market next. But all that changes when we get multi-time frame alignment, because now you know that everyone is leaning one way. Everyone on both the short term and the long term. It doesn't guarantee direction, but it does point that at least the next leg or the next decision of the market will move one way rather than the other. And that's where our win rate really goes through the roof. Now let's see how we'd actually trade it in the real market. Take a look at this. Just by first glance, what do you see here? Well, we see very clearly that the entire ribbon is bearish. All clouds are sloping down heavily, and we have a massive blanket of resistance. So when it comes to direction, what trade should you be looking to take here? We know for certain that it's definitely not going long. I mean, you should not be looking to buy the dip here whatsoever. You'd lose most of the time, and that would tank your win rate. Our bias here is bearish, and we should be scouting for a short. This doesn't mean we blindly enter short either. A downtrend also has spikes and rips that you don't want to get caught in. Because you might be asking yourself that question. The ribbon is bearish, yes, but how do I know that it'll continue going down? The market can clearly flip when it pleases, and even if it's going in my direction, I might still get caught in a move against me. And that's why we look for structure and confirmation. Mainly what we're looking for is downtrend continuation, because the market will either be in an uptrend, in a downtrend, or ranging. And we obviously only want to engage when the market is in an uptrend or downtrend. But if we look here, for example, the market is still in a downtrend, but it's in a range phase. And this range phase can result in the market continuing to range and chop us out, or even flip later on and break higher. So we want to make sure the price is out of this range to maximize our chances of winning. And that means waiting for trend continuation. Right now, we've made a lower high, lower low, then a lower high, and now the price is attempting to make another lower low. But the key is, we want to wait for it to complete before we enter. So, once we get a break lower, we have a high probability entry. That will probably give you another leg down and continue the trend. So if you're trading without the ribbon and just blank charts, your win rate will be low. You'll buy dips when you're not supposed to, and take trades in the wrong direction. Probably 40 to 50%, maybe lower. Even if you get higher over a certain period, it's not something sustainable. Once you add the ribbon and follow the bias, you're aligning with the right direction. This is how you shoot your win rate above 50% consistently, because the trend will work more often than not by definition. And last, if you wait for the structure to confirm and execute properly, you'll avoid more fakeouts and get an even higher win rate. By the way, I help traders master this exact framework by working with them one-on-one. When it clicks and they apply it consistently, the results can be pretty remarkable. Some of them have gone weeks without a losing day. And that's all from applying this structure. So if you're interested, check out the link below to join. Now, getting cloud direction right is what increases win rate. But the other part of the equation is risk reward. Because if you don't have the right entry and exit points, your profitability will be much lower. Your wins will count for less, and your losses will count for more. But you don't need to sacrifice win rate for a better risk reward. You just need to find the ideal entry and exit spots. For that, I use supply and demand levels. I have a whole guide on how to find them here, which I'll link for you to watch later. But supply and demand levels are institutional points with heavy activity, meaning the price is attracted to these levels. And if we apply them on our previous chart, we can see that we get clear entry and exit points. So you'd enter at one level and exit at the next level in the direction of your bias. In this case, we'd wait until price enters a level, then go short and target the demand level under. And we just repeat this process whenever all the clouds in the ribbon align. That's how you nail a high win rate. And that's the answer to the #1 struggle every trader faces. Getting direction right stops being a guessing game the moment you have the right tool. The ribbon gives you that. And once direction is solved, everything else falls into place. Be sure to check out the mentorship below, and I'll see you in the next video.